Is the Reliance Nippon Life Classic Plan 2 the right choice to help you reach your financial goals? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what this policy is about. So this is a unit-linked, non-participating individual life insurance plan, and some of the key features of the policy are: you can ensure your family's financial security with life insurance coverage throughout the policy term, and you can access partial withdrawals from your policy fund in case of emergencies, receive the fund value at maturity including any top-up, and you can customize your premium payment term to suit your financial needs and select from a range of 8 diverse investment funds. Now let us take a look at the benefits available under this plan. So first up is the death benefit, which in the unfortunate event of death of the policyholder, the nominee or the legal heir will get any of these options as a death benefit. So whichever is highest at the date of death, that will be given as a death benefit to the nominee or the legal heir. So in addition to this, if the policyholder had a top-up fund value, then either the top-up sum assured or top-up fund value or 1 or 5% of the top-up premium paid, whichever is highest out of these options will also be given as a death benefit additionally to the standard death benefit available in this plan. Another benefit is the maturity benefit. So once the policy matures, the policyholder will get the total fund value, which is the sum of the base fund value and top-up fund value, if any, will be payable to the policyholder as a maturity benefit. So these are the benefits available under this policy. Now let us take a look at the fund options available in this policy. So there are like 8 to 9 fund options available, which are Life Large Cap Fund, Life Equity Fund 3, Life Pure Equity Fund, Make in India Fund, Life Balanced Fund 1, Life Corporate Bond Fund 1, Life Money Market Fund 1, Life Mid Cap Fund 2, and Discontinued Policy Fund. So all these fund options are categorized based on how much percentage of allocation they are given to the asset classes like equity, debt, money market, and also according to the risk profile each fund has, which can vary from low to high. Now let us take a look at the various charges present under this policy. So first is the premium allocation charge, which will be charged as a percentage of the premium, which will be deducted from your premium amount at the time of premium payment, and the balance premium will then be used to allocate units in the chosen investment funds thereafter. And there is also policy administration charge. So for regular premium policy, 40 rupees per month from here 6 till the end of the policy term. For single premium policy, 40 rupees per month for the entire policy term. So the above charges will increase with inflation of 5% per annum from the 7th policy year onwards. So it can be subjected to a maximum of 6,000 per annum. So mortality charges will vary depending on the amount of your life insurance cover, attained age, occupation, health of the policyholder, and the fund value. It also has accidental death benefit, so it will be charged for that. So the annual charge up to 865 is 1 rupees per 1000 sum assured and will be deducted on a monthly basis. There are also fund management charges, which they charge for managing your fund, and also according to what kind of risk profile you have in your fund. Like the higher the risk, the higher the charges, lower the risk, lower the charges, like that. So the charges can vary from 0.50% to 1.35%. And also there are partial withdrawal charges. In this policy, 2 partial withdrawals in a policy year are free. On every subsequent partial withdrawal, a charge of 100 rupees will be deducted from the withdrawal fund. They also have discontinuance charges, which depends on the year of discontinuance, premium amount, and premium paying term. There are no discontinuance charges from the 5th policy year onward. There are also switching charges. So generally there are 52 free switches in this policy in any policy year and 4 free switches per year during the settlement period. But subsequent switches, if any, will have a fixed charge of 100 rupees per switch. So while the plan offers market-linked investment opportunity, the various charges discussed earlier are deducted from the premium amount. That's why, unlike other market-related products, this plan imposes additional charges that over time can significantly reduce your overall returns. Now let's take a look at the advantages and disadvantages of investing in this policy. So the advantage are: you can boost your investment with optional top-ups, enjoy added security with accidental death coverage, benefit from 52 free switches across 8 investment fund options. You can adjust the investment allocation of future premiums using premium redirection. You can even leverage the systematic transfer plan STP to mitigate mitigate equity market volatility. And there are also disadvantages which this plan does not provide you with a loan facility. So liquidity is also limited during the initial 5 policy years, and premiums are invested only after deducting applicable charges. So these are also some of the drawbacks that you need to keep in mind before deciding to invest in this policy. Now, as we have a basic understanding of this policy, let's move on to the analysis part of the video, where we are going to analyze the IRR, which is the internal rate of return of this policy, to get a better idea and to help us make an informed decision. So for instance, we are going to assume that a 30-year-old male chooses this plan with a sum assured of 5 lakh, a policy term of 15 years and a premium payment term of 15 years. So he pays an annual premium of 50,000 and receives a fund value at maturity. Here we are going to assume the fund value based on two assumed investment returns like 4%, 8%, which indicates worst and best case scenario. So these are not guaranteed returns and they do not indicate the only possible potential range of outcome in this policy. This is just to give you an idea of how it can perform in the worst and best case scenario. So at 4% per annum in the worst case scenario, the fund value at maturity is 8.43 lakh, which results in an IRR of 1.45% as per the policy's maturity calculator. So this IRR is lower than a typical savings account interest rate. So if you had not taken a risk and invested anywhere and just kept your money in a savings account, still it would give you a better return than this. And also this is a worst case scenario. For the best case scenario, at 8% per annum, the fund value at maturity is 11.74 lakh, yielding an IRR of 5.42% as per the policy's maturity calculator, which is less than the interest rate offered by fixed deposits. So despite being a long-term investment, the plan fails to outperform inflation, making it unsuitable for achieving your long-term financial goals. Additionally, the plan offers limited liquidity and does not effectively contribute to wealth accumulation. So investing in this plan may not be the best option for building a strong financial foundation. So as this policy is not giving us a desirable outcome we wanted, now what we are going to do is, to help us make an informed investment decision, we are going to conduct a comparative analysis where we are going to compare the returns from this policy with other investment products. So while this is a ULIP plan, what we are going to do is, we are going to take an alternative approach where we are going to separate the components of insurance and investment and invest in it separately. So in this way, we are going to use the same assumptions from the earlier example from the Reliance policy for this fair comparison. So we are going to keep it as a parameter. So in this, for life cover, we have opted for a pure term life insurance policy with a sum assured of 5 lakhs, which only costs 2,100 rupees annually for premium for a 15-year policy term. So this compared to Reliance policy leaves us with 47,900 rupees annually for investments, whereas we paid 50,000 premium under the Reliance policy. So for investment, if you're a high risk investor, you can opt for equity based instruments like ELSS, while low risk investor can choose debt instrument like PPF. So in PPF scenario, along with term insurance combination, over 15 years, the maturity value of PPF becomes 12.99 lakhs with an IRR of 6.60%. So despite being a low risk debt instrument, PPF offers comparable returns to the 8% scenario of the Reliance Nippon Life Classic Plan to an actually even higher returns. So despite being a low risk debt instrument. And in ELSS scenario with term insurance combination, investing the surplus in ELSS results in a pre-tax maturity value of 19.99 lakhs. So after capital gains tax, the post-tax maturity value is 18.55 lakhs with an IRR of 10.68%. So here, both scenarios outperform the Reliance plan, offering higher returns and greater flexibility. The accumulated funds here can be used to achieve various life goals. So Reliance plan lacks in terms of returns and liquidity, making it less competitive. So what is the final verdict on our analysis? Is the Reliance Nippon Life Classic Plan 2 worth investing or not? As you can see, this policy aims to address two key aspects: investing for life goals and providing financial protection for your family. However, the insurance coverage, which means the sum assured offered under this plan, insufficient to meet your family's future needs. Additionally, the premium charged for this coverage is significantly higher than that of a pure term life insurance policy. So the excess premium is allocated to market linked investments with a maturity value paid to the policyholder. However, a deeper return analysis from this video reveals to us that the potential returns are underwhelming for a long term investment, primarily due to high charges, and this policy also has a high agent commission. So if you're interested in market linked investments, it is more effective to keep insurance and investment separate, as we have seen in the comparative analysis, because this approach enables you to combat inflation and build wealth for your life goals.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.